So today on the show, we're going to talk about cap rates, understanding it, how to use them to value buildings, and some things that I think are definitely misunderstood when you're a new investor. You might only look at the cap rate and why I don't think that's the best idea. So the first thing, the very basic way to understand a cap rate, if you paid all cash for the building, what your return would be. So if you paid $1 million for a building at a 5 cap, you'd get 50,000 back. If you paid $1 million at a 6 cap, you'd get 60,000 back. So the cash flow is higher on a higher cap building, which is enticing when you're a new investor. That's what a lot of people will look at. They'll be taught that, and they might use that as one of the only metrics they look at. We have to have a 6 cap in order to buy a building. Where I think that's a bit of a mistake is what cap rate should be used for is kind of a metric for risk, right? The 5 cap building is going to generally be a better building, better tenants in a better area. It's safer versus the 6 cap, right? And that's dependent on the deal. Sometimes that's not the case, but generally the higher the cap rate, the more risk there is associated with the deal. So if you're just looking at that on a pro forma on a piece of paper, it's more enticing to go with a higher cap rate building because you get that little bit of extra cash flow. But what's missed is all the intangible stuff. If there's more risk or if it's in a worse neighborhood, you're going to have more turnover. You're generally going to have higher vacancy. You're going to have more units that get trashed by tenants. And on that lower cap building, it's generally going to be more stable. If you actually looked at case studies over 10 years, probably the lower cap building is going to outperform the higher cap long term. And I kind of came to that realization when I would look at, when I first started, that's what I was looking at is I wanted the most cash flow possible. And I was looking at really crappy stuff because they had this huge cap rate. And I looked at the big companies and nobody ever scaled that way, right? They generally, if you look at what REITs are buying or huge funds, they're buying below market cap. They're buying concrete high rises, which are, might be a 4 cap when I was buying stuff at a 6. So if you're a bigger fund and you go and buy a 4 cap building, every dollar of income is worth $25 of value to that property when you buy it. If you bought a 6 cap, it's worth 16. So if you look at that and say, we're going to hold this 10 years, we're really good operators, we know we can get the income up, we can get rent increases, we can lower expenses. The value difference of that building on the exit is way higher at a 4 cap, right? Because every dollar extra that you got in rent increases or lowered expenses is worth $25 instead of $16. So you have to look at that on over 10 years and think if I got that extra few percent of cash flow every year versus the upside that I'm going to get on a lower cap building, which is going to work out better, which is going to provide a bigger return over the hold period, which could be 10 years or 5 years, depending on your strategy. And I do think there's a lot of value there in having that safer building where you can get rents up and having the bigger multiple on a lower cap rate. But there does become a point where it doesn't make sense, right? When I started in real estate, interest rates were 1.8% and cap rates were 5.5%. You could probably still find some really good properties that were above that. And for the first time kind of in history, interest rates went up at a crazy amount, the most they ever had in that short period of time. And cap rates didn't go up with them. If anything, they compressed. So the difference in taking money at 1.8% and a cap rate at 5.5%, there was a nice spread there, and it made a lot of sense. Now we're at a time when interest rates are 5 and cap rates are 5. They've lowered, if anything. So that spread isn't there anymore. Now in Canada, CMHCs came in and they put in all these programs, so you only had to put 5% down. You could amortize 50 years longer. And that allowed that to happen, right? If they didn't do that and you had to put 15% down on a 40-year AM, cap rates would have had to go up or nothing could have traded. You couldn't have got any debt servicing. It wouldn't have worked. So they kind of, artificially, I think we've kept them where they are. But as interest rates come down, I don't think you're going to see cap rates keep going down unless it's a super hot market. So in Canada, most people are using CMHC for multifamily, and there's the criteria you have to hit there. So they're going to have a debt service, which right now is very, very low. It's 1.1. So that's kind of allowed people to buy at lower cap rates, even though interest rates are up. They'll also have a cap rate that they value property at, right? So just because you want to go buy a building, you maybe love the location and you're willing to overpay, and you're going to say, hey, I'm going to pay a 4 cap for this, you're not going to get full leverage for that building if CMHC or the bank says, look, we're only going to go to a 5 cap. So they kind of dictate what's able to get financed by the number they use. So as a new investor, don't look at cap rates just as an indicator of cash flow. Understand what they are. They're also an indicator of risk and how it affects your exit. So you really can't control the cap rate on the exit, right? If crazy stuff happens in the world and cap rates go up, it's going to affect it one way. If they go down, it's affected a different way. But one thing I wouldn't do is I've seen some people underwrite and say, wait, we're buying this at a 6 and we're going to exit it at a 5, right? I wouldn't underwrite a lower cap rate on the exit because you don't know that's going to happen. And that's going to artificially inflate the value a huge amount, right? Like I explained, the $25 at a 4 cap and $16 at a 6. So that can make a huge difference in value. That can make the deal work on a piece of paper, but that doesn't mean that's going to happen, right? You have very little control. The market, it dictates the cap rates, and it's honestly, it's like a very, almost a perfect system, right? It is a value of risk, and it values what the market can support for that property. So it is a good metric. I don't think you should try to lower the cap rate for the exit just to make the deal look better. If anything, you could go the other way and you could add 0.5% or 1% on your pro forma and see if the deal still works, right? If you buy it at a 5, if cap rates move to 6 and you get some rent growth, it's still going to probably be a good deal, right? You're going to still make sense of it. And if you get down the road and that's the opposite, you just have a way better deal than you had initially underwrote. So if you understand cap rates, you'll know, if you go to look at a property and the guy's trying to sell it at a 4.5 cap, but everything else in the market trades at a 5, it's overpriced, right? So unless you love the deal, you're going to have to put more money into it because the bank's not going to go along with that. And kind of on the other side as well, if you're in a market where everything's trading at a 5 or 6 cap and you see something come across your desk that's an 8, unless there's huge problems with the property, they're probably, you'll have to do your own underwriting because they're probably inflating the numbers, or I've seen a lot on smaller deals where people, they don't add management fees, they don't add anything in because they don't have that expense. But when you go to finance a property, you have to add all of that in to get CMHC or to get the bank go along with it, so that number is going to come down. So generally really high cap rates aren't that exciting. I mean, I never see something now at the level we're at that's at a 6 anymore. Everything's at that 5 to 5.25, so we know that's going to be in line with what we need to finance. So hopefully that gives you a good understanding of what cap rates are, how they can be used. They're, it's a pretty complex metric the way they figure out what the cap rates are, but they're a pretty simple tool as far as using them to quickly value a property and the level of risk. So thanks for listening today. We're going to be doing a question and answer episode coming up soon. If you have any questions that you'd like me to answer on the show, either send me a DM on Instagram or anywhere where you listen to the show. Send me an email and we'll make sure we get the questions answered. Thanks for scaling up. We'll see you guys next week.